Hello, it is February 1st, 2022. This is As the World Burns. I'm your host, Randall Burns. Today's topic is inflation and the real estate market. Now, at the onset of the pandemic, the Fed announced that they were going to make sure there's plenty of credit available in an attempt to keep the economy afloat. I mean, basically, when the pandemic started, there was a precipitous dip in the market. The Fed loosened the money supply and propped up the market. And this was done by Richard Clarida, the head of the Fed, and Donald Trump was involved in some of the key conversations. Okay. Now, links will be included in the description on this. Now, as a rule, when you do monetary expansion, if you're using it to invest in assets that have a long-term return, it's not such a bad thing, at least if you pick them well. This was not that. This was propping up businesses that were going away anyhow, like oil, which is obviously being replaced now by companies like Tesla. Photovoltaic cells are now a cheaper source of energy than oil. The Exxon's days are numbered. It's just as simple as that. They lied to the public on climate change to prop up their business. They got the public to invest trillions of dollars in the neo-crusades to prop up their business. And they're still going away. It's as simple as that. And Donald Trump and the Federal Reserve in their infinite wisdom decided to prolong the situation. Okay, now, a key part of what they did was prop up mortgage securities. And to understand the significance of this, we need to actually go back to a 19th century economist, Henry George, who's actually probably the greatest economic journalist of all time. I don't respect him as much as an economist. His inspiration came from John Stuart Mill, and he did the public a great service by making John Stuart Mill's writings and ideas much more accessible. But there were a few areas in which he did do some original economics on his own, and one of them had to do with the business cycle and real estate prices. And his theory was that when real estate prices accelerated and reached a bubble, then they would drag the economy down. That normally what real estate would do would be kind of a catch-all for value in the economy that wasn't clearly being traced to labor or more conventional capital investment. And as long as it stayed within that limit, then the economy could function. But it could, by speculative bustle, rise beyond that. And I think that's what the Fed may have induced in this case. Now, it turns out that when we look at, we had a little bit over 7% inflation rate in 2021, but the increase in housing prices, at least in places where people can actually find jobs, was considerably beyond that. Links included below. And mortgages were expanded, whether it made sense and was reflected in the productivity of the property, of the areas in which the property were located or not. Mortgages got expansion. Again, a link is included in the description. Real estate has become something of a piggy bank, and part of the value is that people know that down the road that when they want to, they can borrow against the real estate and do so reliably. And there has been no real containment of that at all, neither for the wealthy 1% or the bottom 95% who have been losing ground since the 1960s, or even the next 4% who've been barely hanging on since 1980. See Richard Wolff, Professor Wolff at Columbia, not Richard. Richard is at the University of Massachusetts. Different Wolff, unrelated. But Ed Wolff at NYU is the leading economist on the distribution of wealth, and he documents my claims in terms of distribution. Now, the influence of this theory on real estate and the business cycle, it's one of these things, it's kind of the turtleneck sweater of economics. It never quite comes into fashion, but it never quite goes away either. And Vickery at Columbia and Herbert Simon at Carnegie Mellon are examples of Nobel laureates who were influenced by this early in their career. They went to work in other areas of economics, but Henry George was a really great writer and popularizer, and he did have his influence that has been ongoing. But he also influenced a couple of popular figures that are important to mention, namely Ralph Nader and Bill Buckley. And as a rule, when you have an idea that can appeal to both the left and the right and is being disparaged by the middle, there's something worth investigating there. It's just a general rule of thumb. Now, what we've also been seeing is that wages have not been rising as fast as inflation or as real estate prices, let alone real estate prices, which have been even faster. So we have a lot of people that are facing real problems right now. Now, addressing, conventional theories of inflation usually deal with monetary supply. Since I was a young man in the early 80s, that's been the dominant tool for managing inflation. There was, as I mentioned in my previous video, there was a big debate between Milton Friedman, and a prominent neo-Keynesian, John Kenneth Galbraith, on the cause of inflation. And Galbraith didn't really systematize his work as well as I think Friedman did, which is why his stuff caught on. But Galbraith wanted to emphasize the productivity aspect. Now, with real estate, we have a mixed bag, The investment in buildings, infrastructure, capital improvement, and general maintenance can modestly affect productivity. Generally, by the way, the investments made in infrastructure generally make a real return. Now, for the first 2 years of this pandemic, we have not had any of the major investments in infrastructure that had been actually promised by Trump when he got elected in 2016. Now, why that didn't happen is not really the key focus of this video, but I think it's an interesting topic and may deserve some mention down the road. I think part of it was he was being dragged down by elements within his own party. I mean, never mind what got him elected, never mind what got them Pennsylvania, Ohio, Michigan, and Wisconsin. They've kind of been the GOP has been kind of in a morass of obfuscation and lower taxes at all cost. And so they kind of lose sight of the types of government expenditure that actually do increase productivity, which are things like infrastructure and R&D, basic science and R&D expenses. Now, a lot of the applied R&D can be taken up by corporate interests like Tesla, that really can do R&D at a very high level, but basic science is still managed in large part by the government. There are proposals to improve that. Bernie Sanders actually had some very interesting proposals in this area for the pharmaceutical industry that may deserve their own video at some point. But we didn't really get that. We just got a lot of money being thrown at propping up business as usual. And so now we have hypothetical increases that would come with recovery already monetized into prices. And it's not clear when the recovery from the pandemic is going to happen, or what's going to happen, or even how it's going to be done yet. I actually have a lot of hope for the kind of throwing everything out of the approach: masks, rapid antigen tests, vaccination, and improvement of air filtration systems. I think that you take those all together and you may really have something. But right now, the public seems to be taking a one thing at a time. I mean, the vaccines were supposed to fix everything. When they're not, then rapid antigen tests are gaining a certain degree of popularity, which I think they deserve, but I think that you really need to take more of a give it everything you've got approach, which is, I think, what will eventually happen. Now, the Fed does not have direct control over real estate policies. They do, however, influence a lot Fannie Mae and Freddie Mac, which have government agencies after all. And the Fed are the ones that have the big research budget, and I think they need to maybe put on their thinking cap and use it a little bit. There is a whole morass of regulations that influence how and when you can get a real estate loan. Okay, and a lot of these are very detailed. Like after 2008 financial crisis, there were properties that were eligible that no longer became eligible, that lost their eligibility or would have to make significant capital improvement in order to maintain eligibility. I think they need to be looking at differentiating explicitly between the underlying property value of land versus improvements. I think they need to be differentiating between smallholders and investors. The smallholders are the ones that are the most vulnerable to a credit squeeze. They need to be given a little bit of consideration, and the main, because they've been the ones that have been losing ground over the last 50 plus years, according to the research of Ed Wolff and NYU. Anything that impinges upon them should be considered very, very dangerous in this climate. The upper 1%, not so much. The upper 0.1%, even less so. They can pay more, and I think that they can be. That's where you need to do your credit crunches on the types of properties that they are most inclined to buy, both residential and investment. And they need to be, I think you need to walk a tightrope between expropriation, which you don't want to do, and indulgence, which has been what's being done, and that indulgence needs to cease ASAP. But we also can differentiate between residential and investment properties. And we can also look at geographic distribution. There have been areas that have been affected differentially. Now, my own feeling based on the example of the 1918 flu pandemic, I think we are going to have long-term economic ramifications of the pandemic. I think that states like Florida that have had bad pandemic management policies are going to be taking a long-term hit on this one. That's what we saw with the 1918 flu pandemic. I think we're still early in this epidemic. We don't know what the long-term effects are going to be, long-term mortality. I think it's going to be greater than a lot of people are expecting now, but that'll be another topic for another video. But we need to be prepared to handle that eventuality as it emerges. That's one, and there need to be some expectations on states for getting credit relief and governmental aid as the necessity for that emerges down the road. And they need to demonstrate productivity increases concurrent with whatever aid and credit relief is given. That just has to be part of the package. Now, the goals here are, again, to preserve existing values to the extent possible, to stabilize those values. Rising real estate prices does not raise real living standards. A house is still a house. Okay. But taking it away can cause investment panic and falls into other areas. When the government shows it cannot maintain investments on a stable basis, people lose confidence in it, and they don't do a lot of the riskier stuff that needs to be done to increase productivity. Okay, and areas like infrastructure construction, which are a traditional government operation, we really do need more of that, particularly in a time of recession or potentially high unemployment. I mean, that's something that needs to be watched very, very carefully. And we need to limit the whole thing of the real estate as a piggy bank as opposed to real estate as something that people use and enjoy. Now, the Fed does have influence over the federal government. Since Reagan, it has become the dominant repository for economic research within the government purview. That needs to be re-examined, and I will at some point do a video on reforming the Fed. The Fed, also as the 600-pound gorilla of economic research in the federal government today, which I understand is a private-public partnership, and that's that's another topic for the Reforming the Fed video. But they can do research reports, and they should in this area. And we can, for example, differentiate in the tax code capital gains from general land appreciation and capital gains that come from capital investment and improvement of property. And the latter is something that should be respected, and there should be relief there. And the larger investors can afford to pay more taxes, and there's no reason why they shouldn't. I mean, when they buy up buildings, there isn't, when they buy up existing buildings, yes, that investment should be respected, but there's no reason why they need to get huge returns relative to smaller investors. It doesn't do a dang thing. And the Fed can also, by its research reports, influence its state governments and spell out the conditions under which states get relief credit and debt relief credit and federal aid. And that should be being researched now before the problems become truly urgent. But we have an issue here. The housing crisis has become a major issue. When I look at the homeless camps here in the Portland area, one of the things that's scary is how many of these people are actually working. Yes, they are living in a tent. They're actually a lot nicer tents than their Depression era peers had, but they're still tents. And these are still pretty squalid conditions. But to say that none of these people are working is kind of missing the point. Yes, there are some living on food stamps and whatever they can scrounge, but there's some that aren't. In fact, there's a lot that aren't. And we need to look at what it's going to take to make an economy that's going to work broadly and do so without causing investment panic, which is another thing that you really don't want in this kind of climate. So, we have a real mess here, and I'm going to be looking at other dimensions of the Fed's policy and the inflation that we see as it's coming. Okay, the real estate speculation is not the only aspect. It's an important aspect, but it's just one of several, and I will be addressing these one at a time. Thank you for joining me today. Please do hit the like button. Please do subscribe to the channel. Suggestions for future episodes are welcome. Areas in this video that you want expanded, mention it, and I will try to get to it. This is a labor of love. Proceeds from these videos are earmarked for long-term care of my nonverbal autistic son. And that I'm not doing this to enrich myself. I'm doing this to help others, including you. So do help me in this task. This is Randall Burns signing off until next time.